in securities markets. He has around 20 years of experience across corporate finance, investing banking, private equity, merger and acquisitions, and debt arranging and syndication. Currently, he provides virtual CFO services to several large clients and offers expertise in debt syndication, valuation services, and GST advisory. Previously, he held senior roles at Aditya Birla Finance, where he managed a portfolio of over 3,500 million rupees, and at Karvi Investment Banking, leading deal origination and execution. Mr. Mehta sir has a strong track record in deal advisory, having worked with high-profile clients across sectors such as infrastructure, retail, and finance. So, sir, I am handing over this class to you. You may proceed.
Good morning, friends. Am I audible clearly? Yeah. So the topic for discussion today is fundamental analysis. And when we say fundamental analysis, we are primarily looking at equities. Let me just share my screen and the presentation, and then we start off from there. Yeah, so you can see the screen.
I can see the screen, and Parth is saying it is visible, and others are saying.
Fine.
And sir, we are live on YouTube also, sir.
Okay.
Okay, sir.
So, friends, let's start defining the term with the term equity. What do we understand by equity? Equity capital means what? Three questions around it. First is it a permanent capital? Is it a temporary capital? Any answers? You can put it in the chat. I can respond to that, and I will answer in any case. The Companies Act defines equity capital as share in the share capital of the company. It means nothing. What does it imply? It's permanent capital, but it's permanent. It is permanent capital. Answer is yes, Parth. It is permanent primarily because the company has no obligation to repay that capital. Equity capital comes with co-ownership of the company in which the capital is held. So what does it entitle? What are the rights to what does it give? If I am a owner of an equity share, what is my entitlement? Normally the answer comes to mind is dividends. What does it imply? Owner stake, dividend. So what is my right to cash flows, I would put it. Right to participate in general and annual general meeting, voting rights. Yes, all those rights are there. But what is it that I am participating in? So if I am a debt holder, if I am owning some bonds in the company, or if I am a lender to a company, my right is to have the interest repayment and the principal repayment, correct? The right to interest and the right to redemption. For an equity shareholder, what is the cash flow to which I am entitled to? So let me define equity shares from a common man understanding so as to understand as to what does it mean. Equity share means the right to the residual cash flows of the company. Right to the residual cash flows of the company, which means that after the entire waterfall, sales minus cost minus overheads comes EBITDA. From the EBITDA reduced interest, which is the interest payable to debt holders. From that reduced depreciation. From that reduced taxation. From that reduced dividend to preference shareholders. And what remains is the right to the equity shareholders. EPS, yes, EPS is the derivative of the earnings per share. So that is the right of the equity shareholder. So the equity share is a right to the residual cash flows of the company. Since it is very difficult to estimate the residual cash flows of the company, normally the greater the uncertainty associated with anything, the greater the riskiness, the greater the likely return, and the greater the likely variability. You see a lot of variability or a lot of volatility in the equity market, primarily because it is a right to the residual cash flows. And since it means a right to the residual cash flows, you are technically anticipating or estimating each of the variables and then the right to the residual cash flows. Therefore, the variability of all these put together is affecting the right to residual cash flows, which is equities, which is why you see the volatility in the equity markets to be much higher as compared to other markets. Primarily because it is after everything else what remains, which means that everything else has to be estimated before you come to equity. Now, equity is a security within the meaning of Securities Contract Regulation Act. Securities Contract Regulation Act defines the term equity, security, and in it includes equity. It also includes derivative, which is the where there is any underlying. It also includes government securities, bonds, and any other tradable instruments or receipts. So, when we are saying as the right to the residual cash flows of the company, and we are looking at trading those rights, what are we implying? So the best estimate of value of an equity right or an equity share is the closest estimate of value is what? Can I say the market price? Yes, no? What is the best estimate of value of an equity share? Suppose a share is a traded commodity. It's a traded on the stock exchange. The best estimate of a particular share as we speak today, the first estimate which we comes to is the market price of the share. Now let us come to the concept of value. Fundamental analysis means what? Let's go by the word fundamental. Fundamental means anything which has a base, which means we are affecting a cause-effect relationship. Cause-effect relationship. Parth, just hold on. Cause-effect relationship. Fundamental means we have fundamental rights under the Constitution. What does it imply? Which means that the basic rights and the basic causation, we are establishing a causation. In case of an equity share and we are doing equity analysis and we are doing fundamental analysis, we are again establishing a causation. That causation is between what? The causation is between the performance of the company and the price of the company. The causation is between the performance of the company and the price of the company. Therefore, the fundamental assumption of fundamental analysis is price, performance drives price. I am putting it on chat. Primary assumption is performance drives price. This is the fundamental. This is the primary assumption of all fundamental analysis. Performance drives price. Now, performance means what performance? Market performance, company performance, peer performance, industry performance. What performance we are talking? Assumption and forecasting. Part assumption and forecasting will come to next. What is forecasting and whether it is required, not required? What does it imply? We'll come to it. We'll come to it later. I will cover these parts. Come to the fundamental primary assumption. Performance drives price, which means that we are saying that the performance of the company is directly linked to the price performance. Therefore, the question of value comes from where? Value means what? Value means, as per mathematics, value means the end result of a particular computation. Let's say we define value as a function, like f of x is equal to 2x plus 2y plus 3x minus e or plus e. So it is a mathematical function of value. From a behavioral perspective, it is a series of, from a behavioral perspective, it is values or individual beliefs that motivate people to act one way or the other. From a price comparison basis, it is what something is worth compared to its price. The moment we say something is worth compared to its price, means what? When we say something is worth compared to its price, means we are saying that our assessment of value of a particular company or a value of a particular equity share is independent of the price at which it is being traded. Do we all agree to this? You can do a thumbs up. Some of you. When we say that one something fundamental analysis derive what something is worth compared to its price, what we are saying is the assessment of the value of that particular equity share is independent of the market price of that particular share which is trading on the stock exchanges. Which means what? Which means that the market price or the daily price fluctuations which we are seeing in the stock exchanges of that particular stock is not a fundamental analyst, but it is a barometer of investor sentiment. You can note it down. The daily price fluctuation of the stock exchanges is not a fundamental analysis. It is a barometer of investor sentiment on a daily basis. So then what is the worth or what is the worth compared to its price? So we just discussed the primary assumption of fundamental analysis, performance drives wealth. Performance drives price. Now what is when we are trying to estimate the value? So the value compared to the price, what is the value? The answer to this question is again a single line. Present value of future cash flows. Present value of future cash flows. The rest of the session we are going to discuss this only. Equals value. Present value of future cash flows looks very beautiful. There are two primary parts to it. One is what is the future cash flows and what is the present value of the future cash flows. Present value means there is an assumption of a particular discounting factor. What is worth today means if I give you 10 rupees tomorrow and 10 rupees 1 year later, the difference in the value because of the time value of money represents the discounting factor. The discounting factor also takes into account the risk underlying those cash flows. So future or the present value of future cash flows. When we are talking about the present value of future cash flows, all and every value in fundamental analysis is only talking about the present value of future cash flows. Either we are talking about a discounted cash flow method, or we are talking about a relative value method, or we are talking about a market approach, which means that if something is compared to something else and we try to establish a value based on comparison, it is still a present value of future cash flows, because what you are assuming implicitly is that the assumption of the future cash flows to which share or to which market you are comparing, your share or your industry mimics that performance, and therefore that comparison is holding true. But at the end of the day, it is present value of future cash flows. That's all there is to it. Now, if I have to give you the price of something, let's say take any particular stock today, for that matter. Let's say let's go to the screen and see what stock we have. Let's pick up any stock today. So we have this. So the DMAT current price or the last traded price is 3,508. What is the earnings corresponding to this price of 3,508? Trailing 12 months, we can see 44.74. Now 44.74 is the earnings of the share. The price which is being traded is 3,500, which means that the price is being traded on a particular multiple to the current earnings of the share. In a realistic scenario at zero growth, the earnings per share should be equivalent to the price. Tata Steel. Parth, you want me to go to Tata Steel? Let's go to Tata Steel. Tata Steel. Price of Tata Steel is 123 rupees. The earnings per share is 12.5 rupees. What is the price earning multiple? Price earning multiple is nothing but the price divided by the last earnings or the trailing 12 months earning. If it is a forward, it will be a forward earnings. But what is the price earning multiple of Tata Steel? 123 divided by 12.5. So roughly 10 times. What is this 10 times? When we are talking about this 10 times or 12 times or 15 times or 30 times, by the way, what is the Nifty PE? Anybody can answer what is the Nifty PE? Currently around what is the Nifty PE? Around 23 times, 23, 25 times. What does it imply? It implies that the market is implying a particular story. I am using the word story on the growth prospects of the company based on the current estimate of the earned earnings. So the value number which you are seeing on the screen today is nothing but numbers from today multiplied by stories about tomorrow. So the market price which we are seeing today is nothing but numbers from today, numbers from today multiplied by stories about tomorrow or stories about the growth prospects of the company. So there is a number element to it, there is a math element to it, and there is a story element to it. When we say the story element to it, it means that this particular method of analysis is part science and part art. The moment we say it is part science and part art, the next question which comes to our mind is how much of it is science and how much of it is art? The entire course on fundamental analysis is basically directed towards bounding the art, increasing the science component of the entire process, and such that it is a science bordering on art and not a art bordering on science. Do you get the drift? So the entire course is designed or an entire analysis of fundamentals is directed towards increasing the science portion and reducing the art portion. The art portion will never be eliminated because the story element will always be there. But what is to be understood is, first of all, the cognizance of that there is a story element. And secondly is that can we put in checks and balances in place to understand the story portion also in a bounded manner so that the scientific principles can be applied to the same. For example, let's give you an example. What has been the historical median PE of the Nifty? Currently, the PE of the Nifty is around 23, 25 times. Historically, if you go by the Nifty has been in place since 1995, historically, what is the range in which the PE of the Nifty has fluctuated at the lower end and at the upper end? If I have to do a time series, which will be across cycles. Between 95 and 2024, we had almost 3 or 4 cycles we have had. Now, what has been the range? If you Google it, you will find that the range is somewhere, or if you look at the data, the range is somewhere between 12.5 times, extremely lower end, 12.5, 13 times, to as high as 30 times. Anybody has any views other than this? They can put it on the chat, or they can give me a thumbs up to go ahead. Can I have some view? Standard deviations, yes. Yes. Parth, yes, standard deviations of Nifty. What is the range in which the price earning multiple of the Nifty has fluctuated over the last 25, 30 years? That is the question which I am asking. I am answering that question that it has been around 12 times to around 30 times. And at extreme cases around 32, 33 times or 35 times also. I'm not talking of the Sensex, I'm talking about the Nifty. So let's go by the number. And it should be, if we go by this number, what it implies is that currently we are trading at 25 times earnings of the Nifty, which means that towards what end of the range we are right now? We are towards the higher end of the range. It doesn't mean that we are necessarily overvalued. What it necessarily means that on a historical basis, we are trading towards the higher end of the range. So the science element of this understanding this range is telling you or is implying today that the current trading values are at the higher end of the historical ranges unless something has drastically changed. This is the science element of it. So now let's go back to the presentation. Yes, from 1700 to 23,000, but let us not look at the absolute value. We are looking at relative values. The price of DMart is 3,408 rupees. Doesn't mean that it is expensive. What it means is that the price is that we have to, the comparison is on value. The comparison is not on price. Just because the price of a particular share is in a few thousands or in a few lakh rupees doesn't mean that the stock is expensive. What it means is that at what earnings and at what value the stock is trading at. So a 2 rupees, a stock which is trading at 2 rupees per share may be cheaper or may be expensive as compared to a stock which may be trading at 60,000 rupees. MRF is trading currently at around what? 60, 70,000 rupees? Because MRF, we can check. 1,13,000 rupees, sorry. And what are some other stocks? Let's say, for example, Sundaram paper trading at 2.29 rupees. Can we say that 2.29 rupees is cheap and 1,13,000 rupees is expensive? Just by comparing the absolute share price? It would be a correct thing to say? It is not a correct thing to say. So the comparison has to be on value. If you look at Sundaram Multipap, the EPS is negative. If you look at MRF, the EPS is positive. That value itself shows that the comparison is faulty. The comparison in the market, whether something is overvalued, undervalued, whether something is valued relative to something or not, is on value, it is not on price. The market price is the trading price, the price at which a particular stock may be traded for a willing buyer and a willing seller, the last traded price. It is not an indicator of value. That's very clear. Now come back to the story element of the entire thing. When we say that market price today or the price at which a particular stock is trading today is a function of numbers from today, if we have to define it on relative terms, multiplied by stories about tomorrow. That leads us to one primary conclusion. Whenever a fact, which is a number, is multiplied by a story, the result is always something less than the fact. Whenever I'm repeating, whenever a fact from today is multiplied by a story about tomorrow or about the future, the resultant figure is always something less than a fact. Agree? Thumbs up. So all predictions, every prediction which you come across in the market or which you make about the market has less than 100% chance of coming true. This is not a bold statement. Let's embrace it. Which means that you have to always push yourself towards room for error and the ability to endure surprise. Because it is not a perfect science. It is not an exact science. Fundamental analysis and the value derived by fundamental analysis is not a perfect science. The first half an hour of this session is being directed to drill it into your heads that what you are trying to learn or what this session is all about is not a perfect science. It is a science bordering on art. Therefore, all discussions when we come to fundamental analysis and when we come to price should be two things. Either it is relative, means with reference to a particular benchmark or with reference to historical averages, or reference to a particular benchmark or with reference to a relationship, or within a particular range. You open CNBC at the end of the day after the market falls and you hear a lot of these analysts and you come across a lot of these analyst reports which says price target of a particular stock 252 rupees, 258 rupees, 1018 rupees. I sometimes think, how do they know exactly that it will stop at 250 rupees, or how do we know it will stop at 1018 rupees? The ideal thing to do is that this particular stock has a 20% upside, has a 15% upside, has a X amount of downside, or it could give returns in the range of 20 to 30% over a period of 2 to 3 years. Beyond this, it is realistically not possible to do a meaningful analysis, at least on the fundamental part of it. And therefore, a large number of reports which we come across today, either from brokerages or from the news sites or from the presses or from various websites associated with those markets, are trying to deliver a level of precision or are trying to deliver a level of accuracy, which is absolutely not possible. So they have chosen to be precisely wrong instead of being vaguely right. Let me put it in that manner. So, because when we do an exercise of valuation, you will realize that the value is fluctuating. And since the value is fluctuating and it is a combination of a science and an art, and therefore we should talk about ranges. So that is the second learning. First we thought is that whenever a fact is multiplied by a story, let's go back to the presentation, sorry. So whenever a fact is multiplied by a story, it is always less than a fact. Secondly is that the most persuasive stories are what we want to believe to be true, or an extension of what we have experienced firsthand. Let me give you an example. How many of you have been trading in the markets? Do you have trading experience? You can just, yes. Are any other participants owning any shares of DMart? Let me give you a specific example of DMart. I have a DMart close to my home. I stay at CBD Bilapur, and I have a DMart close to my home. It is a 50,000 square feet space. 3 years back when it opened, I went to the shop, DMart store for shopping with my family, and I had some 8 or 10 items to purchase. And I was the 10th guy or the 15th guy waiting in the queue at the cash counter to pay the money to buy the purchase. There were 15 other counters, and all the counters were full. And I realized, and many of you would have realized when we went to a DMart store, for example, so many people are waiting in line to pay money. It is not that he is giving a freebie. People are waiting in a queue at DMart to pay money. Just imagine what kind of sales it must be having. There are people who have bought so many items and they are willing to wait in long queues to make the payment and buy it from the store. So the value proposition which this company offers is great. And since so many people are going, there are so many stores across the country, there are so many people waiting. Just imagine what kind of business it would be. So this is something which you experience firsthand. Based on your first-hand experience, you realize, you assess that the stock must be performing very well, the company is performing very well. Since the company is performing very well, the stock market, the stock price of this company will be performing very well. Why? Because intuitively you connected that performance drives price. Fundamental assumption which I described. Intuitively we connected performance drive price. Therefore, since so many people are willing to buy, the company's performance will be very good. Since the company's performance is very good, the price performance is expected to be very good. And let me go and buy a few shares of DMart. That is how it started. So the most persuasive story is what you experienced firsthand. This is what implies. So you created a story that the business is so much. What happened is after that, after some time, you realize that DMart is part of organized retail, and organized retail has its limitations because retail is one of the largest employers in the country in terms of the manpower which is employed in the country. Since it is the largest employers in the country, and the restriction, and DMart is by definition restricting itself to urban conglomerates or urban structures, there are upper bounds to the amount of scaling up which this business can do. And when you brought the share, you paid some, what is the price earning multiple of DMart today? We just saw 3,500 was the price, and the trailing 12 months earnings per share was 44 rupees. So 3,500 divided by 44, 45 rupees comes to what? 3,500 divided by 45 comes to 77 times. So you paid 77 times trailing earnings for a stock of DMart. And then after some reflection, you realized that was this company can only grow at 10 to 15% per annum because it is restricted to urban areas. It is also restricted to availability of prime real estate within the city and affordable real estate within the city where it can open its stores. Therefore, the growth may happen is around 10 to 15%. But when you bought the stock, you told your story was different. Your story was more personal, first-hand experience driven. So the second point which I am trying to explain is that most persuasive stories are what you believe firsthand. These stories needs to be validated. So whenever you make decisions based on first-hand experience, your first-hand experience may not be representative of the actual median or the average experience of the average guy. So take care of that situation. Third, we are trying to figure out something where it is going next. You have to understand more than the technical possibilities. What do you mean by understand more than the technical possibilities? For example, let's go back to the same example of DMart. The government has a policy of single brand retail. DMart is a single brand retail. It has restrictions on the number of stores. For example, the political institution in the country is, let's say, for example, wants to protect the retailer, small retailer. It comes up with a policy that DMart will be restricting its stores to only so many urban conglomerates. Even today, as we speak, there are hardly any DMart stores in the middle of the city of Mumbai because the real estate is not affordable. Therefore, it is restricted to the outskirts of the city. So let's say if the government restricts expanding the outskirts of the city, or if prime real estate is not made available to DMart, then its growth will be technically stunted. Furthermore, it is riding on the urbanization effect. Let's say there are a couple of climate change activities, and because of that, there are some natural disasters, and this urbanization thing, which is being so thriving, slightly goes off. We've already seen that in COVID times, people have experienced working from home and working remotely, which means that the ghettoing of Mumbai, Delhi, Kolkata, Chennai, or for that matter, Bangalore, may not be required going forward, which may reduce the need for urbanization. So what I'm trying to say is, what I'm trying to drive it is that the actual growth may have to be understood in line with the technical possibilities of that growth. While the story is persuasive and you have acted based on your first-hand experience of the story, the technical possibilities or the actual growth will have to be validated based on the on-the-ground situation. The fourth point, when we are understanding price as a function of a fact multiplied by story, is that interest rates. What do we understand by interest rates? With interest rates, we frequently hear every 3 months, every 6 months that the RBI has reduced the repo rate to boost industrial activity. RBI has increased the interest rate to curtail inflation. What is this boosting industry activity? What is this curtailing inflation? Boosting industrial activity means what? Interest is a cost to the business. If the cost is reduced, then the profits which are available for reinvestments are increased. Therefore, a reduction in the interest rates is a positive for corporates because there are more money is available for reinvestment. The ripple effect of interest rate reduction is not just the cost reduction to the corporate. The ripple effect of interest rate reduction is that it has an effect of boosting demand. Since goods will become more affordable with a lower interest rate regime than will in a higher interest rate regime. For example, if the home loan interest rate drops by 200 basis points, the EMI for a 25-year loan may drop by a few thousand per lakh, a few hundreds per lakh. So let's say, for example, EMI per lakh for a 25-year home at 9% is somewhere around 1,100 rupees. If the interest rate goes down from 900 basis points to 700 basis points, that EMI would drop maybe to 950 rupees per lakh. With that drop, the affordability increases. So the interest rate drop acts as a dual leverage. One is it reduces the cost of the corporates since interest is a cost to them and releases more money for reinvestment. And number two, from a consumer perspective, it makes buying things or consuming more affordable. So interest rate is a double-edged sword and it works both ways. Corresponding to that, if there is a drastic increase or an increase in the interest rate, it adds to the cost of the businesses and it makes things less affordable. So always remember, when the interest rates are low, the story side of the equation, that is the fact multiplied by the story, expands. Why it expands? Because the demand drivers get a boost because of higher lower interest rates. The supply side also gets a boost because of the lower interest rates, and therefore the story side of the equation expands. We also use a common term in markets known as interest rate sensitives. What do we understand by interest rate sensitive stocks? Can any of you give a couple of examples of interest rate sensitive stocks which we are normally understood? If you are reading newspapers regularly, if you are seeing the CNBC or the ET Nows or the NDTV profits regularly, this is a term which you would have come across normally. Interest rate sensitive stocks. What do we understand by interest rate sensitive stocks? Financial services stocks like bank, NBFCs are interest rate sensitive. Answer is yes, they are interest rate sensitive. But normally banks and NBFCs work on a spread. So they are actually not interest rate sensitive, they are spread sensitive. Most of these banks and most of these NBFCs define the spread. And if it is variable on both sides, so whenever the RBI reduces the repo rate and after 1 month the bank says, okay, I have also reduced your borrowing rate because the bank spread is being maintained. But banks and NBFCs tend to be interest rate sensitive only to the extent that the demand drivers, for example, if interest rates are low, there may be more demand for housing loans or consumer loans. Real estate is interest rate sensitive, project contract is real estate sensitive. I will give you a classic example of interest rate sensitivity. The total number of two-wheelers which are sold in this country, in terms of volume of the total number of vehicles sold, is almost 77%, which means for every one car or truck which is sold in the country, there are 3 two-wheelers which are sold. And 80% of these two-wheelers are actually financed, either by banks or by NBFCs, making this sector or making this business highly interest rate sensitive. A two-wheeler which is typically brought in this country is brought as a productivity enhancer. Productivity enhancer means that it is linked to the earning output of the person who is using that vehicle. And 80% of these vehicles are purchased on finance. If 80% of these vehicles are purchased on finance and there is an increase in EMI because of interest rate increase, it will affect the demand. More importantly, if financing is not available, it is severely affect the product sale, which is one of the reasons that the likes of Bajaj and Hero Honda, who are the primary players, or TVS for that matter, they set up their own NBFCs to finance two-wheelers at a time when bank used to be away from financing two-wheelers. Banks used to be shy of financing two-wheelers because it was a movable commodity and आदमी लेके भाग जाएगा. So what to do? So Hero Honda, Bajaj, and TVS set up specific finance companies to finance two-wheelers and boost their sales, which was the origin of Bajaj Auto Finance. Hero Finance is also one of the origins, and TVS Finance is also one of them. Now, I have given you an example of two-wheelers being interest rate sensitives. Can you guys give me another example other than real estate or project contract of specific industries, manufacturing industries, which are highly interest rate sensitive? Would any of you like to try? You can put it in the chat box. Yeah, let me give you an example. Capital goods. Capital goods is a highly interest rate sensitive. Somebody is wanting to upgrade his plant and he is borrowing for new machinery which has to be purchased. First of all, at a higher EMI, that machinery may not be viable for him to buy because he may not have the cash flow to pay the higher EMI. Yes. So capital goods is a highly interest rate sensitive sector, like we saw in case of auto finance or auto companies. Third, fifth, and the most important part of the valuation is whenever we are doing a valuation activity and we are understanding the facts with the story, we have to understand the life cycle of the company. So typically, when we say life cycle of the company, NTPC, LNT, NTPC no, LNT yes, insurance no. Insurance is primarily driven because of the need to cover risk. So Amit ji, I would say insurance is typically not really an interest rate sensitive sector in that manner. So understand the company industry life cycle. When I'm saying industry life cycle, let me draw something for you and show it to you. So typically, there are four, I'm taking some time. So four stages: startup, growth, maturity, decline, rejuvenation. Startup, the metrics which will happen in a startup will be different from a growth, which will be different from a maturity. I have another presentation, so we can probably refer to that presentation. Just a second. Can you see this presentation? Startup, rapid expansion, high growth, mature, and decline. Startup companies don't have operating history. There are hardly any comparable firms. The source of value is entirely future growth. Rapid expansion followed by high growth, maturity, and decline. Startup or idea companies, a lot of biotechnology companies, a lot of IT companies, a lot of companies who are developing aerospace technology for that matter. And you would find these startups companies in various industries where they are driving innovation. Rapid expansion phase. The Zomatos and the Swiggies and the Paytms to that matter, for that matter, Paytm earlier, now that it has gone some regulatory action. The fintechs are right now in rapid expansion. The high growth phase. What is the high growth phase? What we saw in DMart few years back, last 5 years in DMart was a high growth phase. What we saw in telecom in the last 10 years was a high growth phase. What is mature growth? Reliance Industries, the refining business of Reliance Business Industries, is in a state of maturity. The banking business of public sector units to a large extent is in a state of maturity. Even for that matter, large private sector players, the typical corporate banking and retail banking, which is there in corporate banking, is in the mature stage. The volumes are growing, but it is not in a rapid growth stage because there is already a level of financial inclusion which has happened in the country. And more loans to people who are not affording loans may be risky. Therefore, there are artificial barriers. Therefore, it is a mature growth. Give me an example of industrial decline in industries. Declining industries. You can put it in the chat box. Yes, Parth FinTech is abnormal growth. Any industries across listed industries which we see, yes, D2H is in a decline. What is happening is D2H telecom players are now bundling things together, and therefore DTH is part of the telecom space, and to that extent D2H is on a drastic decline. Why as a company is on a drastic decline? That is because of the industry structure. I don't think that telecom is in a decline stage. I think telecom is in a maturity stage as a sector. Why may be on a decline? Because of company specific idiosyncratic performance. So part to that extent, I would say, what else have we seen a decline? What else have we seen drastic decline? We used to use USB, remember, to transfer data, we used to use USBs. Sectors who do not adopt technological changes, yes, sectors who do not adopt technological changes, they do see a decline, but they do see a retransformation. When I say decline, means that demand for the products of that sector are drastically declining. For example, if I have to say the software, the storage hardware storage space. Earlier, we used to use pen drives or USB sticks to transfer data. Now we do it on Google Drives or OneDrives. So the requirement to transfer data is not that it has gone away. Just the medium has changed. From hard drives, it has shifted to cloud. So the requirement, that demand is there. When I'm saying decline, it means a secular decline in certain industries because the products are no longer required. Because the products are no longer required. I will give you one classic example. CD drives and tape recorder cassettes. They are not required. That industry saw a rapid decline in a matter of 3 to 4 years. Nobody today uses a CD drive. Earlier laptops, earlier desktops had configured CD drives in them. Today, nobody uses a CD drive. Hardly anybody uses. That whole market has gone away. That demand has gone away because that has been taken up or eaten up by something. The digital cameras have to a large extent gone away for a common person's use because the mobile has taken away the digital camera. So the likes of Nikon or Sony or Konica or Minolta are no longer there. The demand has drastically reduced. So there is a secular decline in certain industries. Normally, when we do fundamental analysis, most of the times, entire teaching is to map and to value companies which are in the mature growth phase. Because what we are taught, look at last 3 years data, last 4 years data. Based on last 3 years or 4 years data, try to estimate or try to forecast what the company will be doing in the foreseeable future. And then derive a set of projections. And from that projections, discount those projections to a present value and try and arrive at the value of the company. Which means by definition that we are assuming that the growth stage is somewhere around high growth or mature. Therefore, the traditional methods of valuing companies like a discounted cash flow method, which is the income approach, is technically or generally more susceptible or more usage is more in case of high growth and mature growth rather than in case of startup phase or rapid expansion phase. This aspect needs to be understood. When we are doing a valuation, at which stage the company and the sector in which the company operates is there will have a huge impact on the kind of story which is built into the price and the method which are employed to value that particular stock. For example, if we are valuing a Zomato today, or maybe 3 years back, if we are trying to value a Zomato or a Swiggy and they were making heavy losses, if you are using a discounted cash flow method and you are projecting that the losses will continue, the value would technically be zero. Yes, no, can't say. We assumed that there was a particular turnaround which was expected because as the volumes would rise, the company would turn around and there would be profitability. With profitability, there would be value in the company and therefore it should be valued at a particular price. Therefore, we had to understand the life cycle or the industry stage in which the company is or was. Without that understanding, our valuation analysis would have no meaning. So let's go back to the presentation. We've discussed this basic assumption of fundamental analysis that performance drives wealth. Performance is what the company is making for me. What is the company making for you? Dividends, earnings per share. Dividend is a subset of earnings per share. Even though not distributed, it is something with your name in the company. Whereas wealth is what comes to your pocket. So wealth realization is one, earning of dividend, and secondly is capital gains by trading that particular stock. The utility of fundamental analysis. We just discussed a few minutes back that the daily market is not a fundamental analysis, but it is a barometer of investor sentiments. Therefore, the primary assumption which any person practicing fundamental analysis does is to say that the value is independent of the market price at which the particular stock is trading. Therefore, it is a search for an intrinsic value. And based on that understanding of intrinsic value or value of the company, decide whether to buy or not, or to sell or not. Therefore, fundamental analysis utility is in a particular time frame. Let me give you a very straight example. If I hold something, if I hold my hand too close to the eye, I can't see. At the same time, if I put my hand too away, let's say I have two long hands and my hand is too away from my eye, I still can't see. Which means what? We can't see what will happen tomorrow. We can't estimate what will happen tomorrow. We also cannot estimate or we also cannot forecast what will happen many, many years later. Therefore, there is a predictable range. What is that predictable range? Typically in the markets, we say a business cycle or a couple of business cycles at the maximum. The predictable range, therefore, is 3 to 5 years, maybe 5 to 7 years. Beyond that, it is not possible to predict meaningfully for us to act. We can't see tomorrow, we can't see many years later. We can't see the secular, we can't see the immediate. What we can see is the near to medium term. Therefore, if there is a long-term horizon, say in excess of 5 years, 5 years, 7 years, 8 years, 10 years, fundamental analysis works beautifully well. If it is a medium term, say 3 to 5 years, it is better. Near term, moderate. Because let's understand the utility of fundamentals. Fundamental analysis कर लिया, but and you said okay, the value of demand currently is trading at 3,588 rupees, or for that matter, Tata Steel is trading at 3,000. Tata Steel is trading at 123 rupees. And according to me, the price of Tata Steel should be 150 rupees or 160 rupees. Whether you are right, whether you are wrong, that will only be decided based on whether the market converges with your opinion. Suppose you have done your analysis that Tata Steel is valued 150 rupees and the price continues to trade at 120 rupees, which means what? Which means that the market does not converge with your opinion, which means that technically you are wrong. The stock market is a beautiful mechanism at which shows the mirror to each investor whether he is right or wrong. If he is right, you are making money. If you are wrong, you are not making money. As simple as that. You don't need to ask anybody. You don't need to look at anything. If you have taken a certain call and if you have done a particular analysis, and if you are right, the market is to converge to what your analysis is. If the market does not converge to what your analysis is, your realization of your thesis will not happen. Therefore, the mirror is with you. You don't need to ask anybody whether you are performing correctly or not correctly. The market tells you that. The very short term, against it's very low, day trading negligible. Similarly, secularly period, it is negligible because it's not possible to see too far in the future. 20 साल के बाद क्या होगा ये नहीं बता सकते, कल क्या होगा ये भी नहीं बता सकते. But what can happen in a typical business cycle of 5 to 7 years? Yes, that can be mapped, that can be predicted, and action can be planned or based on that. So let's move to the next slide. We just have 2 sentences in this slide. How many of you have ever done a discounted cash flow analysis or tried to do a valuation by yourself earlier? Are there any of you who tried to? Yes. You have tried, Akash, you have tried, Parth, you have tried, Akansha, you have tried, Parth, you have tried. So you used discounted cash flow method of analysis or you used a relative valuation method of analysis? What method you tried and used, tried to use? Income approach, discounted cash flow? Yes. So in the discounted cash flow, if I have to do firm valuation based on discounted cash flow, discounted cash flow means what basically? It means the same thing, present value of future cash flows. The same words which we have used half an hour back is what is there in the discounted cash flows. So discounted cash flows, the way to remember what goes into a discounted cash flows, I have a small uh, uh, norm for that or a catch for that. We all understand Panch Mahabhut, no? Jal, Vayu, Prithvi, Akash, Agni. So I also have a 5 Panch Mahabhut of discounted cash flow. 5 elements of discounted cash flow. What are the 5 elements of discounted cash flow? What are the 5 elements of discounted cash flow? I'm putting it in the chat box also. First element is the cash profit in the business. If you are valuing a firm, so it is nothing but EBITDA minus tax, earnings before interest, depreciation, and tax minus taxation. That is the cash profit of the business from the firm perspective. Cost of capital, terminal value, profits, enterprise value. Parth, I will cover profits is right. I have covered it in the cash portion. Cost of capital, let's call it WACC or weighted average cost of capital, which is a combination of debt and equity cost. This we are doing the firm valuation. Third, so Parth, you have mentioned cost of capital. I have covered it in WACC. Terminal value. What is terminal value? Can any of you have any idea? You can put it in the chat box. Let's examine your own portfolio or your own investment. Let's say you have bought ITC stock. The stock has a dividend yield currently of around 2.5%, 3%. So price is trading at around 400, between 400 and 450 last time when I saw. So let's say it is trading at, you can go to the screen actually and show you that. So ITC is trading at 439 rupees. The dividend yield of ITC is what? What is the last dividend which the company has paid? You can go to corporate action. And final dividend, 7.5 rupees I see. Interim dividend was 6.25. So 7.5 plus 6.25 comes to 13.75. 13.75 divided by 13.75 divided by 440 rupees. So this is the last dividend yield. So roughly around 3%. Do you all agree? Yes. So when I buy a share of ITC, I am expecting that next year, assuming the company maintains the same dividend yield, I will be entitled to a 3% dividend. Plus what? Plus the price at which I will be able to sell that particular stock at the end of 1 year. So let's say the current traded price is 440 rupees. And next year, I expect the price of ITC to be 460 rupees. So in 1 year, I am assuming that I will get 13 rupees or 14 rupees as dividend, and I will be able to make a capital gain, which is a realization of my cost at a profit from 430 rupees to 460 rupees, which means 30 rupees of profit. So my returns from ITC are predicated on earnings, which is 3 rupees or 3.5 rupees, 3.5%, or 13 rupees in absolute terms, plus 30 rupees at end term gains. That 30 rupees which you are talking from an investor perspective that I will be able to realize when I sell it eventually at the end of 1 year is nothing but the terminal value. Do you agree or you don't agree? That amount from an individual investor's perspective, don't get into company's perspective. It is ideal to, because we are all investors and we are all market analysts in our own way. So the ideal is to understand it through your own lens. So from an individual perspective, the price at which you will be expecting to sell that particular stock at the end of your holding period, which is let's say 1 year or 2 years, the difference between the price at which you bought and the difference between the price at which you expect to sell, that is the terminal value from the individual perspective. Now come to the company perspective. When you are doing a valuation of a company, so for example, I am running a business today. Let's say Zomato is running a business today, and next year it is expecting to have a dividend of 2 rupees, next to next year 3 rupees, next to next year 4, next to next year 5. And at the end of the projecting period, let's say we project for a business cycle of 5 years, we say that Zomato at the end of fifth year would likely be valued at X. The difference between that value and today's value represents the gain from technical value. So terminal value is nothing but the expected price at which the company will be valued at the end of the forecast period. Do you agree? Now, there may be various methods of valuing that terminal value. One is relative value. For example, today ITC is trading at 3% dividend yield. You expect that same dividend yield to continue. And after 5 years, ITC's dividend from currently 13 rupees goes to 20 rupees. So 20 divided by 3%. That may be one of the ways of estimating terminal value. Beyond that, there may be cash flow based or the Gordon model, which we call, where we say what is the terminal value cash flow and derive a present value of that terminal value cash flow, or a terminal value growth rate. So third is terminal value. So out of the 5 elements or the Pancha Mahabhut of the discounted cash flow, first is the cash profit, second is the WACC or the cost of debt or the average cost of debt and average cost of equity, and be divided by the weighted average cost. Terminal value. What is the fourth component? Answer is changes in working capital. For example, today the sales of the company is 100 rupees. Next year, the sales are projected to be 120 rupees. To increase the sales from 100 rupees to 120 rupees, the 20 rupees of incremental sales may require the company to reinvest about 3 rupees or 5 rupees as working capital back into the company. That reinvestment towards working capital is represented by changes in working capital. What is the fifth element? Capital expenditure. Capital expenditure. For example, if you are running a cement plant and you are already operating at 90% capacity, technically you are not able to operate more than 90% capacity level. And for further growth, you will have to put up another plant, which means that either you will have to reinvest your own earnings to put up that plant or borrow something to put up that another plant. That investment or that reinvestment towards expansion is capital expenditure. So the 5 elements of discounted cash flow from a firm perspective, drill this into your head. Cash flow, EBITDA minus tax, WACC, combination of debt and equity, terminal value, the expected price at which the company will be valued at the end of the forecast period, the reinvestment amount, that is a changing in working capital, and the capital expenditure. Is this clear? Now looking at these 5 elements, is any of these elements anything, any number from the present or from the past? Cash flow and EBITDA is the forecasted cash flow and the forecasted EBITDA. WACC is the forecasted cost of equity and cost of debt combination. Terminal value is the expected price at the end of the forecast period. Changes in working capital pertains to changes to have growth. Capital expenditure is future. So there is nothing in the discounted cash flow which we are using any number which is pertaining to the past. Guys, whoever has run the discounted cash flow method, can you agree or can you not agree, or do you have a different view? I am making a statement. There is nothing in the discounted cash flow system or analysis which is pertaining to the past. Everything is pertaining to the future. Yes, no? Yes. Parth, no. Can you explain, Parth, what is it that is, what is the number in the discounted cash flow which you are using, which is pertaining to the past? The future may have a derivation from past. Okay, past this was a number and therefore future this would be a number. But is it a future number or is it a past number? Yes, because for the base we need the past data. You are implying that the current company performance is a base from which the company will grow in the future. That is a very good base. But if you are looking at 3 years back, if you are looking at Swiggy or if you are looking at Zomato, when they were heavily loss making, or for that matter Paytm till about a year back, did the past data tell you anything as to when and how it will become profitable in the future? You made an assumption about the future with a base of a past, but the entire assumptions were futuristic. They were not that, okay, past I have done an EBITDA of minus 20%, so future also I will do a EBITDA of minus 20%. Did the analyst of Zomato or Swiggy or Paytm for that matter? It is dependent on the life cycle, which you have already covered, Parth. It is dependent on the life cycle of a company. But is the past, is the number which we are using pertaining to the past, or is the number which we are pertaining to the future? The number which we are using in the DCF is pertaining to the future and future only. The past is used only for 2 reasons. One is to act as a check, whether we are going way too high, way too low, or is the future number has a proper basis of assumption. And secondly what? First is to have a base, whether we have a check. And secondly, it is dependent on the future scenario reading. For example, when you are projecting that Paytm as an app will keep growing because it will add more and more users because of the ease of operating the entire thing on an app, we are estimating a futuristic scenario. That futuristic scenario may or may not have a based on past financials. What I am trying to drive at is that the past financial is a good analytical point, is a good starting base, but it is not an end in itself. So for all the people who are non-accountants here on this class or who are onto this course and they feel that they are at a disadvantage simply because they are not able to read financial statements properly or past financial statements properly or do some analysis of past financial state properly in terms of ratio analysis or not, they are not at a great disadvantage because the numbers which we are using in a DCF are all pertaining to the future. And therefore, the prime quality to be able to successfully value a company, especially under the discounted cash flow method or the income approach, is to be able to predict the future or to be able to build future scenarios and come up with what the future scenarios would look like rather than trying and analyzing the past only. Do you guys agree? One of the reasons why there are a lot of non-accountants, if that were the case, that everything was predicated on past financials, most of the people who have been outperforming in the market would be accountants. But accountants are not the people who are mostly outperforming the markets. Because the valuation is not predicated on analysis of past financials only. The past financial is only to act as a base, act as a supporting level, act as an understanding of what is the current standing of the company, so that based on the current standing of the company, we are able to build future scenarios. And if you are scientifically inclined, and if you understand that somebody has a better view of the future as compared to you, even though you may be more powerful at analyzing the past data, the first person will have an edge. Because the valuation of that company is dependent on the future, not on the present. There is no number in the discounted cash flow analysis which we are using from the past or from the current. We are using all numbers. The first year of discounted cash flow analysis, if we have to do a discounting cash flow analysis today, will be FY24 number or it will be FY25 number? Can you answer that question? The first year of discounted cash flow, if you have to run a discounted cash flow analysis today, will be based on FY25 or financial year 25 number or financial year 24 number? The answer is it will be based on financial year 25 number, because financial year 25 has already happened. What has happened has no value, because that has already happened. Since it has already happened, we are predicating it on the future. What FY24 will tell us is that based on a particular scale, based on a particular level of operations, based on a particular level of demand, based on a particular level of management confidence, the company is able to deliver so much profitability. So we are confident that given the scenario in FY24, and given the scenario in FY24, the company will be able to continue this performance based on the management confidence that in the past it has been able to do. Since it has been able to deliver it in the past, it will also be able to deliver it in the future. That is the assumption. But it is future. What if there is something drastic happening in the future, which the management is not capable of tracking? Give you an example. Almost all the car companies in the country have taken some exposure, some way exposure to electronic vehicle technology. Do you agree? Tata Motors has got a big, in fact, 90% of the vehicles, passenger vehicles sold in the country of electronic vehicles come from Tata stable. TVS Motors have invested in electronic vehicle technology. Bajaj Auto has invested in electronic technology. There is a Hero Electric company. All the existing incumbents of the automotive market have made investments towards electronic vehicles. Primarily, according to me, the reason being that they are not sure as to when will the tide turn against the traditional petrol diesel engines in favor of the electronic vehicle engines. The tide may be gradual, the tide may be overnight or very rapid. As the charging infrastructure expands, as the range anxiety of electronic vehicles is reduced, we may see that there is a drastic shift from petrol diesel vehicles to electronic vehicles. Now, to alleviate this black swan events or one-time events, or as to when this will happen, they have built up their investments portfolio in the electronic vehicles. So let's say, for that matter, if you are analyzing a particular automotive company, And that company today has not invested anything in the electronic vehicle space, or is not at all prepared to ride the EV space, or even to transition towards the electronic vehicle space. And we are sure that this is a big trend of movement from traditional fossil fuel based vehicles to a electronic vehicle base, and that company is not prepared. Tell me, would analyzing the past financials and extrapolating those past financial make sense? Because when you are valuing, you are using future numbers. But if the company has got no EV exposure, it is not at all prepared for a EV scenario, will it make sense to use past financial to make future numbers? I would say it will hardly make any sense. It would hardly make any sense to use past financial numbers to make future projections. So therefore, the reason why I'm coming again and again on this particular point is, all you non-accountants, don't think that you are at a disadvantage when it comes to valuation because you don't understand past financials or you don't know how exactly to read financial statements. This class, I will give you hints. I will try and give you some shortcuts. I will try and give you some actually advice based on experience as to how to go about reading and deciphering financial statements, so that that disadvantage, which per se does not exist according to me, is also converted to a perceived advantage rather than a disadvantage. uh, Rohit, Ashutosh, Madhav here. When do we need to break? Accordingly, I need to pace myself. Ashutosh, are you there? Yeah, so I think Ashutosh is not responding, so we'll just carry on for some time before he responds. So we were at trying to explain that the discounted cash flow, everything is pertaining to the future. The second statement, which is there on the slide, is the dead outnumber the living 14 is to 1, and we ignore the cumulative experience of such a huge majority of mankind to our peril. To our peril. What is it that I am trying to say? We have heard this statement, no, history repeats itself. Does it repeat? The answer is no. If history exactly repeated itself, then historians, the people who are studying history or the historians would be the most wealthiest people. No? So a combination of accountants and historians would be the wealthiest people in the market. But that is not the case because history does not repeat itself. But history rhymes. History does rhyme. Human behavior has not changed. The market cycles have not changed. Maybe they have shortened, they have elongated, but history does rhyme. Therefore, the second statement as to the dead outnumber the living 14 is to 1, and we ignore the cumulative experience of such a huge majority. By that I mean we need to refer to history. We need to refer to how past things have happened, how past things have unfolded, how the market mania has worked out, how the corrections happened, how the bull markets happened, how the bull markets ended. So typically, what is characteristic of a bull market is bubble. People use the word no, अभी market में bubble है. I keep hearing these words no. There is a bubble formation which is happening. What is the basis of bubble formation? On what basis we are concluding that there is a bubble formation happening? I am not asking about specific data or specific activity. I am not asking for specific data, specific activity. What I am saying is that what is the genesis of the bubble? A bubble happens in only those cases or only those scenarios where the chances of immediate gain are very high. There are no exercise bubbles. Everybody knows that if you exercise daily, you will acquire good health. But despite that fact, despite the fundamental understanding of that, there are no exercise bubbles. Bubble happens only and only in scenarios or in cases where the benefits are near term, but the disadvantages may be long term. Only in those scenarios. And the market is plays a place where people can acquire overnight wealth. Not many people do acquire. But market is a place where many people want to acquire overnight wealth. And therefore, it is susceptible to bubble. So bubbles will happen only in cases where there is a possibility of instant gratification. Whichever market, whichever commodity, whichever stock, instant gratification is not possible, we will not have a bubble in those markets. Stock market, therefore, is a typical scenario where it is susceptible to bubble. Therefore, study past market experiences. There's a saying which says you should read more history and less of forecast, which is truly right. Just give me a minute. I'll just. Yeah, sorry. So we'll just do one more slide before we break for 15 minutes. Few commonly misunderstood jargons. We hear these words, no, top down, bottoms up. Fundamental analysis, we are a top down analyst, we are a bottoms up analyst. What do you mean by top down, bottoms up? Anybody? Top down, bottoms up? Few minutes back, I gave you an example of first-hand experience in case of DMart. I bought some things, 8 or 10 articles. I was waiting in the queue, and there were 10 other people who had hired in the line. There were 15 counters. I realized that DMart has got around 130 stores. 130 stores, so many people waiting. Just imagine what kind of business this company must be doing and what kind of performance this company must be delivering. Let me go and buy its stock price. That kind of approach, first-hand approach, going back based on your own experience, your own analysis of a particular company, without looking at the overall macro position or the overall industry position, that position is a bottoms-up approach. Now, there is nothing wrong with a bottoms-up approach, which means you start with a company, give first-hand weightage to your own experience, which is very good actually. There is nothing wrong with it. But what happens is that most research is done bottoms up, but it is validated top down. What does we mean by validation of top down? By top down validation, it means is, let's again go back to the DMart example. We acquired some position in DMart stock. Then we said, okay, what is the size of organized retail in the country? Okay, organized retail today is at around 15% of the overall retail market in the country. The overall retail market is in the country somewhere around 12 lakh crore rupees, which means that the organized retail market is somewhere around 1,50,000 crore rupees. Now, when we say the organized retail market is 1,50,000 crore rupees and the organized retail market is only restricted to urban centers as of today, and the real estate being highly expensive, in the city centers, which means that the organized market is restricted. Bhavna, economic analysis, industry, company analysis is top to bottom approach. Answer is yes. What I'm trying to show is that most of the thesis as investors, when we act as retail investors or when we act as a group of investors, most of the ideas are generated bottoms up, which means that you are weighing your first-hand experience, or you are picking up a company, you met a particular company, you met a particular senior management of the company, you picked your hands at a particular annual report of the company or some presentation of the company, and you realize that this company makes for a good investment. So your idea generation is bottoms up, whereas your validation of your position sizing and how much you should commit and the investment validation is being done tops down. So in DMart, what we did do? Okay, 1,50,000 is a retail size market. Within 1,50,000 rupees, it is restricted to the outer areas or the outer corners of urban sectors. At what rate are they growing? How many of them are growing? Then we realized that, okay, there are barriers to the growth, natural barriers to the growth, because you are restricted to the urban sectors and the outskirts of the urban sectors. So this sector or this organized retail maybe can grow at 2 times GDP, or maybe let's say 14-15%, or maybe for example, even 20%, but nothing more than that. That validation that, okay, this business is not a business which is going to go to the sky, came from top-down approach, not from bottoms-up approach. Do you agree? So the top-down approach and a bottoms-up approach, they are not one to the exclusion of the other. They are used together. Most of the times, most of the research is done. Idea generation bottoms up, validation top down. I hope you guys have understood what do you when you use the words top down approach, bottoms up approach, what is it? They are used not interchangeably, they are distinct, but they are used together. They are complementary to each other. They are not mutually exclusive. So with this, guys, let's break for 15 to 20 minutes and we resume at around 11:45, 11:50. Uh, yeah, I'm just turning off my, stopping the screen share and stopping my video. Thanks. See you back. Yeah, so shall we start? Can you see my screen and can you hear me? Can you just, yeah. So we covered the concept of top down and bottoms up. Now we keep hearing these are certain commonly misunderstood jargons before we proceed ahead on this topic. Commodity plays, we keep hearing, no, ये stock तो commodity stock है, this is a commodity play. What do you mean by commodity? Commodity means what? Commodity means what? When do you say that a particular product or a particular service is a commoditized product or a commoditized service? What does it imply? What does it imply? What it implies is that banking, for example, is the ultimate commodity business. MDP services. Banking yeah, it's up. Banking is just give me a second. The Wi-Fi is having a problem. Okay. All NBFCs have only one product, which is money. Correct? It is only the different levels of service at the branch or the user experience or the customer service that is different. But the product is the same. Product is money. Money or variants of money. Partha, you replied when it is daily usage essential items. No, the answer is absolutely wrong. FMCG, fast moving consumer goods, are considered to be non-commodities because there are brands involved. What I mean by commodities, what is meant by commodities in the market is that a product does not compete on price because the price of that product is market determined. Example, steel, oil. The price of steel gets decided internationally in the international market, and India picks up that price internationally. And the price at which the products are sold in the market here it has a direct linkage to the international selling price of that particular commodity. Oil price is determined internationally. There is no wonder there are no oil rigs which have come up in the last many years in India, despite there being some oil possibilities of allowing some oil in some basins like the KG basin or the Godavari basin or the northeast. Primarily because the price at which the cost of production of that oil or the cost of extracting that oil is higher than the market price at which oil is trading because the price of oil is internationally determined. ONGC, for all you know, produces the maximum oil in the country and it is a price taker. What it has is in control is its cost. It does not have any control over the selling price of oil. What Tata Steel has control over is cost. It does not have any control over its selling price. Therefore, any product or any service where the competition is on cost rather than the price is a commodity. So I am defining the commodity for all of you guys. You won't find this definition, but this is the industry definition. Any product or any service wherein the competition is on costs rather than price is a commodity. Yeah. Have you understood what is a commodity? What is a commodity play? The 200-year history of commodity prices says that there is no increase in the price of commodities apart from inflation adjustment. So whenever you read the word a commodity stock hai, commodity play hai, commodity industry है, it means that the competition is on cost. Let me give you an example. Many years back, when I used to be a PGP student, maybe this was sometime in 2005 6, I happened to read an article of Ghanshyam Das Birla, Aditya Birla for that matter, and Aditya Birla was speaking about his interactions with his grandfather Ghanshyam Das Birla, who was a patria of the Birla group. So Aditya Birla was a top industrialist in the 1995s, and he was talking to the journalist, and he said ki when I wanted to expand Hindalco, which is the leading aluminum player, Hindalco being a commodity in that manner because the price of aluminum is determined internationally. So he went to his grandfather Ghanshyam Das Birla and he told him that, okay, today Hindalco is a large player in the country, but I would like Hindalco to be a large player at the world stage, not just India. And therefore, we should have a hold over the international aluminum market, and Hindalco should be a prime player in that aluminum market. When that was transpired, Ghanshyam Das Birla's reaction was that, look here, kid, you can do this, but two things you need to take care of this in this kind of a market. What are those two things? He told Aditya Birla that Hindalco needs to be the lowest cost producer of aluminum in the world, and it needs to be the last man standing. Last man standing means what? The holding capacity in a downturn, that everybody may go out of business, but you continue to survive the downturn so that whenever there is an upswing, you are the first beneficiary of that upswing. So, two things: lowest cost producer and last man standing. Lowest cost producer, commodities. So, cost of production, because they are competing on cost, lowest cost producer. And last man standing means the financial flexibility to weather out downturns. Because the downturns may be steep, downturns may be acute, and people may not be able to survive a downturn. Which is why every 5 to 7 years, whenever there is a steel cycle or whenever there is a major commodity cycle, you see a few steel players going bankrupt or going out of business. It is the nature of the industry. So if they don't have enough wherewithal to survive a cycle, they may not be able to survive a cycle because the price is market determined. It is only the cost of production which they are straddling. I hope this concept is well understood by everybody because it is very important concept to understand when you do analysis of cyclical commoditized industries in your career. Next, it comes to the next concept of cyclicity. What do we understand by cyclicity? Cyclicity means what? Can you give me an example of cyclicity? We have heard these terms of business cycle, commodity cycle, investment cycle. Cyclicity means what? The typical cycle which you have a wheel. It goes up, comes down, goes up, comes down, goes up, comes down. What is the reason for cyclicity in any particular industry? Any particular industry, what is the reason of cyclicity? This is a question. You can type your responses in the chat box. Anybody would like to take a try as to what is the reason for cyclicity? Hotel management industry is not a cyclical industry from a vacation and a festival standpoint of view, Partha. That festival point of view or vacation standpoint of view, typically hotel results spike during vacations and festive season, and that is happening year on year. That is part of seasonality. It is a seasonality of that business that it is spiking in the festival season. Umbrella is also a seasonality. It is not a cycle. Every year you know that the demand for umbrellas will spike in the month of May and June or July. That is the nature of the seasonality of that industry. There is nothing cyclical about it. Navneet Publication, it is one of the major players which do books for these school students. Every year they have a cyclical, the seasonality associated with it. Real estate is cyclical. This is an example. Steel may be cyclical. Capital goods is a very big cyclical industry. These are examples of cyclical industries. But what we are trying to see is what causes cyclicity. That is the question, that is the thing which you need to understand primarily. Not what is cyclical and what not is. If you understand as to what causes, guys, don't mind if I sip some tea on my when I speak. If it is okay with you, I hope it's okay with you. What is the cause of cyclicity? The cause of cyclicity is that the adjustment of demand and the adjustment of supply does not happen in the near immediate term. For example, typically setting up a steel plant takes anywhere between 3 to 5 years. Typically completing any real estate project of a particular size takes 3 to 4 years. By the time the steel plant is set up, by the time the project is completed, the demand scenario may change, which means that the supply gets bumped up or supply is scarce and the demand scenario changes. So typically what happens is supply comes in lumps, whereas demand happens in a linear manner or it fluctuates in a linear manner. So for example, today India is taking up many infrastructure projects and because of that, the steel demand has shot up like anything. Now the steel demand has shot up like anything. Already industries in the steel sector are operating at 75-80% capacity utilization, which means that for every incremental output, there are more number of people who are willing to buy and more number of billers who are willing to pay a higher price, which leads to expansion in margins. Looking at those expanded margins and looking at the better returns, more players are attracted to invest in the steel industry, or existing players go on a capex spree because the profitability of the industry is greatly enhanced in that season of scarce demand. To capture the extra profit and meet the extra demand, capex is put up. This capex happens over and fructifies over 3 to 5 years. At the end of 3 to 5 years, you may see that the demand may have grown only marginally or the demand gets suppressed, because of which there is oversupply. That oversupply leads to compression in the margins. That compression in the margin drives out certain players of the market who are not competitive on cost, which leads to the sowing of the seeds of the next upcycle. That when demand expands, the number of players available who are willing to supply against the demand are less, and therefore the price expands, and therefore the profitability expands, and this cycle goes on. This going on of this cycle, up cycle, down cycle, expansion in margins, attracting new players, leading to a oversupply, then contracting of margins, some players going out of the market, leading to a scenario of balance supply, then again increasing supply, increasing margins because the demand spikes or the supply is not. This cyclicity, this is cyclicity. Have you guys understood what I mean? What is mean by cyclicity? Or do I need to come again? I have tried to, so the difference or the lumpiness in supply vis-a-vis demand creates cyclicity. Cyclicity is primarily created on account of time taken for supply responses in response to changes in demand. I have punched something in the chat box for your reference. Cyclicity is primarily created on account of time taken for supply responses in response to changes in demand. But typically we hear this, na, ki FMCG is a non-cyclical industry. Have you guys heard this? FMCG is a non-cyclical industry. Pharma is a non-cyclical industry. Yes? Have you guys heard this? FMCG is a non-cyclical. You can put your responses in the chat box. So FMCG is typically considered as a non-cyclical industry. The reason why it is considered as non-cyclical, chemicals is a cyclical industry, base chemicals is a cyclical industry. Answer is yes. Whereas the formulations portion may not be cyclical because it is branded to that to some extent, and to some extent it is reliant on the end user industry. Base chemicals is cyclical. Partha, I am answering your question. Raki Singh, with respect to FMCG, what is it called? Fast moving consumer goods. What does the name itself imply? Fast moving. Fast moving word means what? There is a daily demand. It is a daily demand means what? It is a life sustaining product. It is a part of the essential bouquet of products. So come what may, even if there is a market downturn tomorrow, you may continue using your soap for bathing. What may happen is that because of financial crash, you may downgrade from using a Dove to using a Lifebuoy, but you will continue using a soap. Which means that come what may, the demand for soaps will not go beyond a particular downside level, which means that the supply response to that demand continues, that the demand supply imbalance doesn't happen. And therefore, since that demand supply imbalance does not happen, that makes that industry non-cyclical. Pharma, whether I am financially crunched or not, if I am ill and my doctor has prescribed a particular medicine, I have to take that medicine. Which means that the demand for pharma is non-elastic. At the same time, it is not fluctuating. Whenever I am being given a prescription, I will go and buy that drug. So overall, the supply side did not continuously adjust, did not adjust immediately to demand because the demand is not fluctuating much. Since the demand is not fluctuating much, there is a cushion that supply response can be properly planned. There is no disruption between the demand supply imbalance. That is leading to it being a non-cyclical in nature. Have I answered your question, Raki? Raki, have I answered your question? Yes. So any other doubts on this concept of cyclicity? So these all the items which are listed in this slide are normally, I find that they are misunderstood. Top down, I have a top down approach. I have a bottoms approach. No, nobody has a top down approach. Nobody has a bottom up approach. Primarily, there may be a bottoms up approach, but the validation happens top down. Primarily, it may be a top down approach, but the actual stock selection may happen bottoms up. So it is a combination. Commodity plays, competition is on cost, not on price. That makes it a commodity. Prime examples, steel, aluminum, metals for that matter, where prices are determined internationally, oil, and banking is the biggest commodity when it comes to service. You need a loan. If HDFC doesn't give you, and if State Bank is ready to give you, you will take it from State Bank. Because there is no difference between the color of money which HDFC gives you and State Bank gives you. The only difference is in the customer service end of it. The product is the same. The product is commoditized. Cyclicity we have understood. Similar, now understood the concept of cyclicity, there are some counter-cyclical industries. Means industries which benefit from chaos. One of the industries may be the sin industries, tobacco, liquor. Market goes down by let's say 2,000 points. And somebody who is smoking, he gets more depressed and stressed. He said, let me smoke 2 more cigarettes a day. So these are some industries which may actually benefit from market downturn or market chaos. And therefore, they are to that extent counter-cyclical, or we also use the term defensive industries. Defense industry is also a defensive industry, the defense industry in India, because irrespective of where the GDP is going to that extent or where the market is going, the defense input is a prime strategic importance to the defense input, and therefore this industry will continue to generate its demand. Some infrastructure projects are actually defensive in nature. COVID happened, a lot of private projects, a lot of private expansions were on hold. But the infrastructure projects which were led by the government of India, they were not on hold. They were continued. That made them defensive industries. Rate sensitive, we did discuss rate sensitivity in the earlier slides. So let us not go back to rate sensitivity now. I think we've understood rate sensitivity. If there is any question on understanding of rate sensitivity, interest rate sensitivity, please come message on the chat box. I'm waiting for a half a minute. Mean reversion. What do we mean by mean reversion? Mean reversion means what? If a particular company is growing or if a particular country, for that matter, India is growing at 5 to 7% on an average, and there are years in which it has grown at 8 to 10%, and the long-term trend of the country is 5 to 7%, then the country going back from 8 to 10% to 5 to 7%, which is the mean or the average growth rate of the country, is an example of mean reversion. When we say mean reversion, are we referring to prices, or are we referring to growth rates, or are we referring to margins? In case of company, are we referring to growth rates or margins, or the price of that particular company or the stock? Anybody would like to take a punt? Put it in the chat box, please. I would appreciate some participation. When we are talking, let me repeat the question. When you are talking about mean reversion, are we talking about reverting back to the average growth rate or the average margins or the average stock price? The answer is we are looking at reverting back to the average growth rates or the average margins. For example, in case of cyclical industries, at the peak, the margins, EBITDA margins is going to 20%. In a trough, it is going to as low as 5 to 7%. The average may be somewhere around 12 to 14%. So the reversion is with respect to the average margin or the average growth rate, not the absolute stock price or the absolute sales or the absolute margin. In a growing country, even if there is a downturn, you may see that the sales of cyclical industries are still going up. But that doesn't mean that the cyclicity has changed. What is there is that the margins have come down to the average margin. So that is mean reversion. I hope I have explained the concept of mean reversion. Let's go to the next. If there is any doubt, please ping me on the chat box. So recap of a few capital corporate finance concepts. Let me come back to this slide later and dwell fast into the understanding of financial statements. So this segment for guys who are not from the accounting background, and even for guys who are not from the accounting background, I am trying to give you some perspective. I am a chartered accountant myself, and I don't see that the financial statements are an end in itself. I have a lot of friends who are non-chartered accountants and who are not from the accounting backgrounds, and they are doing beautifully well in the markets. And in terms of fundamental analysis also. So since financial statements are acting as a base, let us figure out to understand how financial statements need to be read by non-accountants, people who are not from the accounting background, and even people who are from the accounting backgrounds. Please lend your ear because I'm giving you a perspective. Typically in balance sheet, what do we see in a balance sheet? Assets and liabilities, correct? So if I open an Excel sheet, let's say I open this Excel sheet. Okay. In this Excel sheet, I make a balance sheet. So this is liabilities. This is assets. Okay. This is rupees. This is rupees, let's say. So first you will have the share capital. First you will have the share capital, then retained earnings, borrowings, let's say long term. I'm just making it simple, short term. Let's say this is 100, this is 50, this is 50, this is 50. Total is on the asset side. Let's say we have fixed assets, 50, investments, 20, then we have current assets, debtors or receivables, inventory or cash bank balances. So let's say this is 50, this is 50, this is 20, this total is 120, and from this we have less payables or creditors. Okay, so let's say this is minus 20. This is how much? This is 170. Let us just match it and make it easy for you. Let's check it 60. Okay. So this is a balance sheet. This is normally, this is a very simple plain balance sheet. Now, what is the equation we can make out of it? Let's think of balance sheet. Everybody, people may not understand financial statements, but everybody has done basic arithmetic and basic algebra in school. We can understand arithmetic and algebra. So can we write a balance sheet as a set of equations? Liabilities is equal to assets. The primary equation of the balance sheet is what? Shareholders fund capital is equal to assets minus liabilities. Assets minus borrowed funds. So this share capital. So share capital means owner's funds. Share capital plus retained earnings is assets minus liabilities. Liabilities, I mean outside liabilities. Correct? These are liabilities. So in this equation, what is the answer? Assets is 250 minus long-term borrowings minus short-term borrowings. 150, this is 150. Now this is a principal equation. Now, as you go to more and more legs of the balance sheet or the P&L, you can keep on coming up with these equations. So profit or loss is what? Income minus expenses. Asset is long-term assets plus short-term assets. Liability is long-term liability plus short-term liabilities. Long-term funds is long-term assets minus long-term liabilities. Short-term funds is short-term assets minus short-term liabilities. Free cash flow to business is what? Cash from operating activities minus cash from business investing activities. What is free cash flow to equity holders? Free cash flow from business minus payment to non-equity holders. Are you guys, the non-accountants in the class, are trying to understand what I'm trying to convey so that you can use it meaningfully? You can read the balance sheet as a set of equations where the principal equation is share capital or owner's equity is equal to asset minus outside liabilities. And everything else is a derivative of that. So let's say if I tell you in this, going back to the spreadsheet, if I tell you, okay, I don't have the figure of inventory. Let's say I don't have the figure of inventory here, it is 0. I'm deleting this. Now, and let's say this inventory is X. Can you guys write an equation to figure out this X? Because assets, this 250 needs to be equal to this 250. And since this 250 needs to be equal to this 250, this number X has to be 60. Am I making sense? So what is the equation? Total of owner's equity plus outside liability is 250. So 250 is a minus all other assets other than inventory. What are the other assets other than inventory? This minus this minus this. What remains is 60. So inventory is 60. Am I making sense? So look at balance sheet as a set of equations and your life will be far simpler, especially for the non-accountants. Don't try to think that this is not being understood by us. Yeah. Now, I have mentioned a hierarchy of reading annual reports. Typical annual reports which come to you, they would be 200 pages, 250 pages. And you think कि कहाँ से start करूँ? पहले तो director's report आता है, and then the chairman report comes. Then I have a corporate governance report. Then I have management discussion analysis, followed by a ESG sustainability report. Then comes the standalone financials. First comes the P&L, second comes the balance sheet, then cash flow comes, then some 50 pages of notes to accounts comes. After that, within notes to account, there is a related party note. There is a note on segment reporting. Then there is an independent auditor's report about the consolidated financials. In the consolidated financials, you will have the consolidated balance sheet, P&L, cash flow, then the notes to the consolidated financials, then the schedules to the consolidated financials, segment reporting, related parties, etc. पूरा मिलके it comes to 200, 250 pages or 300 pages, and you feel कि यार, if I have to read two annual reports, where do I start, where do I end? For everybody of you, go to the cash flow. The value of the business by the income approach, the valuation is the rights to the residual cash flows. That is the definition of equity. So what are you concerned with primarily? Cash flow. Look at the cash flow statement. The cash flow statement will have three heads. Let me open one pro forma annual report to show it to you. So this is an annual report of a company called Precision Camshafts. I had it on my laptop, so I'm just using it. You know, you guys, it's freely available on the net, but let's just focus on the. So I go to consolidated cash. So what you guys see is a consolidated cash flow statement. Everybody can see clearly. So what is the profit before tax? 60 crores or 600 lakhs. This is in lakhs, so let us talk in crores for ease of reference. The cash flow from operating activities is 130 crores. Last financial year, this cash flow from operating activities was 103 crores. The cash profit or the profit before tax last year was 60.27 crores. This year it is 60.17 crores. More or less the same. This means what? This means that the profitability last year and this year is more or less the same on a P&L basis. But the cash flow from operating activities has expanded. What is the difference between profitability and cash flow from operating activities? Changes in working capital, which means that the working capital intensity of the business has reduced by 30 crores in this financial year. Because 20 crores, 130 minus 103, so 30 crores. So the cash flow is telling that 30 crores cash has been generated in this financial year by reducing the working capital requirement of the company for achieving the same level of profitability. Just one page which we have referred is giving you some insight. Now, how this 130 crores has been used? Entire amount has been paid as dividend or some amount has been reinvested by the company for its own cash. 94 crores is the cash from investing activities, which means that out of 130 crores, 94 crores was redeployed in the business by way of investments, out of which 65 crores is in purchase of property, plant and equipment. Means the company may have set up a new plant or may have done some capex. So out of 130 crores, the composition of 130 crores is that 60 crores is profitability. The remainder is working capital adjustment. Over and above last financial year, the company has improved working capital intensity by 20 crores. 130 crores, may say 95 crores is used as investments for reinvesting, and the remainder is financial activities, which is minus 12 crores. So 130 minus 94 comes to 35. Out of 35, the company has repaid about 12.5 crores. This is the number. And the remainder is retained in the company as cash and bank balances. Is everybody followed on this? Has everybody followed this reading of a consolidated cash flow statement? Now, in the presentation, I have given the hierarchy. First is cash flow statement. Next, go to balance sheet. Now, let's use this go to balance sheet. Let me tell you, this is a more than a 200-page annual report. The number of pages in this annual report is how much? Let me see. Yeah. So now go to the balance sheet. What is the balance sheet of this company telling us? This is a balance sheet. This is a consolidated balance sheet. So this is an income statement. Sorry. The balance sheet. Yeah. Can you guys see clearly? Or do I need to increase the font or expand the... This is better? So what is the capital of the company? 748 crores is the capital of the company. The total balance sheet size is 143 crores, 1043 crores, out of which 748 crores is the company's own equity in the business. The remainder is funded by way of external borrowings or short term and long term. So 1043 is the total balance sheet size, 748 is the net worth. So the remainder, about 250 crores, is what the company has borrowed. Against this 1043 crores of balance sheet size, the net block or the non-current assets is around 371 crores, and the remainder around 630 crores are current assets. Out of the remainder current assets, cash and bank balances put together are around 87 crores. Against the annual profitability or profit before tax of 60 crores, it has a cash balance of around 85 crores, 86 crores, which means the entire profitability of the year is practically kept in cash or is available at cash. This shows that the company's near-term liquidity profile is very nice, and there is unlikely scenario that the company may have any financial distress issues. This is the reading of the balance sheet. Now, against this 748 crores of own capital, this is the number 748 crores of own capital, and the balance sheet of 1043 crores, what is the turnover which the company has been able to generate? Now go to the P&L. The income which the company has been able to generate is around 1059 crores, which is 1060 crores on a balance sheet size of 1043 and a net worth of 750, which means that the asset turnover ratio of the company, the overall asset turnover of ratio of the company is roughly 1. What is the asset turnover? The total assets divided by the turnover. The asset turnover ratio. It shows the efficiency of the company in utilizing its assets. Let me ask a question as to what do you mean by the word asset? We use the word asset. Asset, anything which is recognized in the balance sheet as an asset, what does it mean? What does it imply? When we use the term asset, what does it imply? Asset means anything from which future economic benefits are derived. That is the definition of asset. Anything from which future economic benefits are derived is the meaning of an asset. So assets generate income, which pays for the expenses and which pays for the investors, or which pays for the capital holders or the debt holders. So assets generate income. So anything which has the ability to generate income is an asset. Beyond that, there is no other asset, which is why we have every year testing of impairment of assets. When we do testing for impairment of assets, what do we mean by testing for impairment of assets? When we mean testing for impairment is whether an asset will be able to continue to generate the income which is from which it is expected to generate, or there will be a decline in the income generation, or there will be a reduction in the income generation, or the asset is incapable of generating any income. So anything which is incapable of generating income is not an asset. Have you understood the definition of an asset? So asset turnover is the capital is calculating the efficiency of utilizing the asset. So in this case, in this balance sheet, the asset turnover ratio is roughly around 1. Now, the asset turnover ratio can be further segregated into 3 parts. We can have a fixed asset turnover ratio, or we can have a working capital asset turnover ratio. So in this case, let us go to what is the fixed asset turnover ratio. What is the fixed assets here? 371 crores against a turnover of 1060 crores. So 1060 divided by 1060 divided by 371. 2.85 times is the fixed asset turnover ratio. Means 1 rupee of investment in fixed asset is producing 2.85 rupees of turnover for the company. Is this definition understood? What does it imply? 1 rupee of investment in fixed asset is able to generate 2.85 times or 2.85 rupees of turnover. Similarly, working capital. What is the working capital? 1060 is a turnover. Working capital is 630. 630. So the working capital turnover is 1.68, which means what? 1 rupee of investment in working capital or current assets, working capital delivers a turnover of 1.68. So that is the intensity of the asset turnover ratios or this. So it is an indicator of the higher the asset turnover ratios, the better the efficiency. The better the efficiency, better the return on capital employed. Did you guys understand, or do I need to come again on anything? This is very important. Looking for a response. Or can we proceed further? Yeah. So next, first go to the balance sheet. Preet Chadda, Preet Chida, and I like to repeat again. Yeah. Preet, you first read the cash flow. From the cash flow, you inferred that the company has a profit before tax of around 60 crores. This is the number you inferred. Last year also the profit before tax was around 60 crores, which means that there is no real expansion in the profitability. But the cash from operating activities has expanded from 103 crores to 130 crores, which means that the expansion has been driven by changes in working capital, which means the working capital intensity of the business has reduced, which is a positive. How this 130 crores has been utilized? 94 crores has been used by investing activities, which is increasing of capex for future growth. And the remainder, out of the remainder, 12.5 crores, this is 12.5 crores, has been repaid to existing debt holders. From this repayment, the remainder is held as cash. Now we went to the balance sheet and we looked at the balance sheet and we realized that the total size of the balance sheet of the company, which is net worth plus the borrowings, is roughly around 1,000 is roughly around 1043 crores. Out of the 1043 crores, this is 1043 crores, the total value balance sheet size. 743 crores or roughly 750 crores is the owner's equity in the company. The remainder is borrowings, which is roughly around 250 crores of borrowings, 250 or 300 crores of borrowings, and the remainder is equity. Of this equity, so against this total capital employed of 1043, how much turnover it has generated? The turnover which it has generated is around 1060 crores, which is 1060, which is roughly 1 times, which means that every 1 rupee investment in its balance sheet delivers a correspondingly 1 rupee turnover increase. Can we broadly say that? Have you understood this, Preet? Can you respond? Have you understood this? Yes. So every 1 rupee of increase in assets delivers a 1 rupee corresponding increase in turnover. So 1 rupee corresponding increase, and now we are further breaking up those assets into fixed assets and current assets. Fixed asset is 3.6367 crores out of the total 1043 crores. Fixed asset is roughly 371 crores, and the remainder 662 crores is current assets. So if I do a turnover to fixed assets ratio, it will come to 3 point something. And if I do a working capital to turnover ratio, it will come to around 1.68, which means that I am further segregating the turnover ratio into saying that every 1 rupee of investment in fixed assets delivers around 2.85 rupees of additional turnover, and every 1 rupee of investment in fixed asset in current assets delivers a turnover of 1.68. Have you understood this completely? This is where we are. So what we have done, we have read 3 reports: cash flow, followed by balance sheet, followed by P&L. And we have come to this broad understanding. Thus, 3 pages of the annual report delivers such an understanding. So when you read annual reports, try and follow this hierarchy. Next, go to segmental results. In segmental results, what you will see? In segmental results, what we would see? You will see in the segmental results that what are the segments, various business segments which the company has, and what is the performance. Now, these segments can be business segments, it can be geographical segments. For example, if the company has overseas operations, then the out of India business may be a geographical segment. And if the company is into various products and categories, for example, if Reliance Industries is into oil and retail, then oil, retail, and telecom, these are separate business segments. For example, in case of precision camshafts, the balance sheet which we have opened, overseas business and Indian business may be a business segment. So you can look at segmental results to understand which segment is performing, which segment is not performing. Let us just see what is the segmental results here in this balance sheet. Segment. Yeah. So in this balance sheet, we can see within India and outside India. So out of the total 1,000 crores of revenue, within India revenue is 398 crores. Asia is 70 crores, Europe is 355 crores, and others is around 200 crores. So out of the total turnover of 1,000 crores, around 400 crores is domestic, rest of it is outside India. This implies what? We will know about this company is dependent on growth outside India. So if the European Union is going to have a problem, and this company has 35% of its turnover from the European Union, tells you that you need to watch out for and take care of that in the numbers when you project it. Similarly, if it is heavily dependent on India, and in India there is some turmoil, then you need to take care of that. So go to the segment result. Now, within the segmental results, this is the revenue information, and this is the asset information. So 100 crores, 200 crores of revenue in India. The assets deployed within India is around 311 crores. The assets deployed overseas is around 467 crores. So this is a breakup of assets, this is a breakup of income. After segment reporting, go to related party transactions. Related party transactions will tell you what are the interlinkages between the promoter group entities and the companies having significant influence, if yes or if no. Related party transactions are not necessarily transactions which indicate some kind of collusion or some kind of wrongdoing. There could be genuine related party transactions. For example, if management paying itself a fair remuneration for the services which they are giving the company, that may be a fair remuneration at arm's length basis. Another example I'll give you, for example, if there are synergistic businesses, for example, if you're reading Apollo Pharmacy balance sheet, and in Apollo Pharmacy balance sheet, you will find that hospital's balance sheet that Apollo has its own pharmacy, which is run in the name of Apollo Pharmacy, and it buys all its medicine from that pharmacy unit. So is it a related party transaction? Yes, it is 100% a related party transaction. But Apollo Group of Hospitals has done that because it wants to ensure that the medical supply chain is operating uninterrupted. No distributors or no wholesalers hold themselves to ransom. At the same time, the cold chain and the temperature controlled medicines are maintained properly. So they have owned a pharmacy. So that pharmacy is part of their consolidated balance sheet. It is a related party. But that doesn't necessarily mean that that related party is of a spurious or a suspicious nature. Related party transactions do not necessarily imply that it is of a spurious or a suspicious nature. The only issue which happens in related party transaction is the transactions have not happened on an arm's length basis. So look out for related parties. Then refer to notes to accounts. Go to the auditor's report. Look at the key audit points, emphasis of matter, and the management responses to those audit points. For example, if there is an audit point saying that the company has not provided for employee benefits, or the company has not provided for provision for gratuity, the management may have a response. The management may say that, okay, we have not provided for the SEMs, but we have identified certain insurance policies which we will be undertaking next year to ensure also the average gratuity payment which the company is making today or is likely to make in the near future is not a very material amount, and therefore to that extent this qualification needs to be read accordingly. Then director's report, and then corporate governance and internal controls report at the last. Now you guys may wonder, corporate governance is not an important matter that it has to be read at the last. Why not first? Did this question come to your mind? In the hierarchy of reading of annual reports, I have mentioned corporate governance and internal control reports at the end, not at the beginning. Does it mean that corporate governance is not important? Does it mean that internal controls are not important? Any responses? Does it mean that corporate governance is not important? The answer is that corporate governance is very vital, but most of the times in case of listed entities, if there are any violations of corporate governance or if there are any violations, major violations of internal control, most of the times you don't need to wait till the end of the financial year for the company's audit report to be printed and given to you. That will be available to you on the stock exchange website. It will be reported to the stock exchange. It will be read in the news. So violations on corporate governance gets reported immediately. Once they are reported immediately, you don't need to go through it fully again. Therefore, in the annual report, at the end, you may skip the section on corporate governance or keep it for the end, assuming that you are tracking the company and you are going through the updates on the company. I hope this point is clear. Most importantly, I have a suggestion that you should always try reading previous year's annual reports to figure out and compare with the actual results. This will give you a level of confidence from a management perspective. This will give you a level of confidence. Now, let us spend the next 10-15 minutes on some ratios because that is part of the suggested this thing. So I have a few slides. Now, ratios can broadly be segregated into P&L ratios and balance sheet ratios. First of all, ratios can be historical, means previous financials, or it could be based on forward. You could have projected financials or you could have estimated financials, and ratios could also be forward. Ratios could also be historical. Assets deliver income and liabilities entail obligations. Obligations means expense. So ratios can be divided into two categories. Income and expense ratios, or we call the P&L ratios, or we call the balance sheet ratios. The most patent ratios are the one involving cross ratios, which one P&L and one balance sheet item. For example, we just covered asset turnover ratio, fixed asset turnover ratio, working capital turnover ratio. These are cross ratios, where one number is from the balance sheet and another number is from the P&L. The cross ratios, where there is a one number from the balance sheet, one number from the P&L, are indicators of efficiency. Generally, they are indicators of efficiency. Like, for example, in the current case where we indicated that the asset turnover ratio of precision camshafts is 1, means every 1 rupee increase in the asset value leads to a 1 rupee increase in the sales level. It is an indicator of efficiency. So all cross ratios are generally indicators of efficiency. Now let's go to the Excel sheet, which I have just broadly prepared for us to understand. So what are the P&L ratios? The gross margin ratio. P&L ratio means what? Both the numbers. A ratio means two numbers, one in the numerator, one in the denominator. If both the numbers are from the profit or loss or the income statement, then there is a P&L ratio. The gross margin ratio is gross margin divided by the turnover. That is the gross margin ratio. The EBITDA margin ratio is EBITDA divided by the turnover. That is the EBITDA ratio. The PAT margin is the profit after tax divided by the turnover. That is a profitability ratio. The raw material cost to sales ratio is also a P&L ratio, because the raw material cost as percentage to sales is an indicator of both the numbers out of the P&L. It is an indicator of the P&L ratio. The overheads to sales is also a P&L ratio. Come to balance sheet ratios. Current ratio, quick ratio, fixed assets to net current assets, debt to equity. All the calculations. What is the current ratio is defined as current assets divided by current liabilities. Current assets consist of what? Current assets. The moment we say something as a current asset means that it is realizable in the next 1 year. Anything which is realizable beyond 1 year is generally not considered as a current asset. Is this understood? Current asset is an asset which is realizable in the next 1 year. So if you have long-term debtors contracts where the debtors are not realizable and they are realizable in 2 years or 3 years, for example, in EPC companies, you will have retained earnings. Those retained earnings are realizable only after 2 years or 3 years when the project and the warranty period is over. These are non-current assets. These are not current assets. They will not be formed part of the current asset calculation ratio. So current assets typically include stocks, inventories, debtors, receivables, and other current assets like cash and bank balances or some advance payments which the company would have made. Current liabilities would typically include payables. Again, current assets and current liabilities. So you use the word current in the numerator, you use the current in the denominator. Again, liabilities which are payable in the next 1 year are current liabilities. Liabilities which are payable in the next 1 year are current assets. Current assets which are realizable in the next 1 year is current assets. And liabilities which are payable in the next 1 year are current liabilities. So the ratio between current assets and current liabilities is a current ratio. Normally, it is said that the current ratio should typically be at least 1 time, which means what? The amount which the company has to receive from the market should at least be equivalent to the amount which the company has to pay. But does it mean that if a current ratio is less than 1, it is wrong or it is bad? Not necessary. For example, you have DMart. Typically, all these large retail chains, they are making all their sales in cash across the counter. Maximum you have credit card swipes, which also gets realized in the next 24 hours. But their purchases are on credit. They don't pay their vendors immediately. They pay their vendors 30 days later, 60 days later, sometimes 90 days later. This results in higher number of payables or creditors, and therefore the current ratio may be slightly lower than 1. doesn't necessarily mean that it is bad or it is. But normally for all businesses, generally the current ratio should be at least 1, which means that the amount which the company has to recover from the market should be equivalent to the amount which is payable as in the next 1 year. Quick ratio, as the name suggests, quick ratio is a subset of current ratio. In current ratio, what are the components? Stock, debtors, other current assets, cash and bank balances. Now, stock may not be readily realizable. Debtors may not be immediately realizable. What is immediately realizable? The cash and bank balance is immediately realizable. So from the current assets, if you remove those items which are not immediately realizable and replace the denominator of current assets with those items which are immediately realizable, the resultant is what you get is a quick ratio. Have you guys understood what is a current ratio and what is a quick ratio? If you can just put it in the chat box. I'm waiting for a response. Yeah. Fixed assets to net current assets. In the balance sheet which we saw of precision cam charts, the total balance sheet size was total balance sheet size was around 1040 crores. No, I remember that. Yeah. The total balance sheet size was 1043 crores. Out of the total balance sheet size of 1043 crores, 371 crores was the fixed assets and the remainder was current assets. So what is the segregation of current assets and fixed assets? We realize in this that the asset turnover ratio is 1. But now what is the segregation? Means for every 1 rupee of investment in asset, I am able to deliver 1 rupees of turnover. But that 1 rupee of investment in asset has to be in what proportion? So the fixed assets to current asset ratio is telling me that that proportion should be 3.7 rupees in 37 paisa in fixed assets and the remainder 63 paisa in current assets. So that is a fixed assets to net current assets ratio. Debt to equity ratio, very important ratio. How much the company has borrowed, which vis-a-vis how much the company's own money is in the business. Debt equity ratio, what is the benchmark debt equity ratios? Now to understand and interpret all these ratios, one needs some kind of a benchmark. Either an industry benchmark or company created benchmark. So what would be ideal debt equity ratio? It can vary widely. In case of power companies, etc., where the revenue is fairly certain, the debt equity ratio may be very high because they may be able to support a higher level of debt. In case of certain industries where the demand fluctuation is very high, for example, capital goods, because it is very cyclical, the debt equity ratio beyond a point may not be sustainable. So what is the ideal debt equity ratio? That is each independent industry and a company call. And depending on the riskiness of the way in which the business is conducted. Some businesses may not want any debt, even if their cash flows may be very good to support debt. Whereas some business may be working on debt or without which they may not be able to work on it. For example, EPC companies. EPC companies necessarily need to have project finance working, otherwise they may not be able to perform. So debt equity ratio is again a very important ratio, but a subjective ratio as to what should be a benchmark. Now let us come to the cross ratios, where we have one part of the ratio, one input of the ratio coming from the P&L, another input of the ratio coming from the balance sheet. So we've already discussed the asset turnover ratios, working capital turnover ratios. Within working capital turnover, we normally have receivable days, payable days, means how many number of days of receivables is the company carrying. For example, let us go to this balance sheet and see what is the amount of receivables. So the receivables in this balance sheet is 175 crores against a turnover of 1060 crores. So what is the receivable turnover ratio in this case? 1060, receivable turnover is 1060 divided by 175. So this is times. So the company is able to churn its receivables 6 times a year, which means what is the average number of days of receivables, which is 365 divided by this ratio. So 60 days. That means the company is able to, on an average, realize its receivables within 60 days of making a sale. Similarly, we will have inventory turnover ratio. Similarly, we would have payables turnover ratio. Generally, in what number of days the company has to pay when it makes a purchase? That is the payable turnover ratio. Ashutosh, can we continue for 5 more minutes or do we need to stop at sharp at 1?
We can continue till 1:15.
5, 7 minutes more?
Yes, sir, of course.
No problem? I'm not able to hear you.
Continue it, sir. Hello.
Yeah, 5, 7 minutes more is okay.
Yes, sir, of course you can continue.
So now the most important ratio, after explaining this, I will break, we will stop the session. Most important ratio is a return on capital employed, return on net worth. What is a return on capital employed? What is the capital employed in the business? So let's define capital employed. Capital employed is own money, which is share capital plus reserves plus borrowings. Correct? Now borrowings could be long term and short term. Correct? So what is the number? So what is the earnings which corresponds to this? What is available to owners? Profit after tax is available to the owners. Profit after tax. And what is available to the lenders? Interest. Correct? So this return becomes the numerator and this becomes the denominator. So this is nothing but return, which is in turn profit after tax plus interest and divided by capital employed. Capital employed is nothing but own money plus borrowings. This is the return on capital employed. Now, if we have to do return on net worth, we are only talking about equity. So what is available to the equity holders? Profit after tax. And against what? Against their share capital plus reserves. This is return on net worth. The difference between return on capital employed and return on net worth is on account of the leverage of the company. So if the return on capital employed, can there be a scenario where the return on capital employed is more than the return on equity or return on net worth? Return on net worth is also called return on equity. Can there be a scenario where the return on capital employed will be more than the return on equity? Part 2 months debtors pay the debt, yes. Can there be a scenario where the return on capital employed as a percentage is be more than the return on net worth? Theoretically, is it possible? The answer is no. The answer is no. Right? Because return on capital employed is generally a lower number as compared to return on equity because it is a subset. There is a company called DuPont. It's an international organization, DuPont. They used to use a framework and it is called DuPont analysis. You can Google DuPont analysis. So what they did is they broke up the return on capital employed into various constituents. So they said, okay, return on capital employed is return divided by capital employed. And how much capital should I deploy? That is based on asset turnover ratio. And how much asset should I deploy? That is based on reinvestment, which comes from profit. So if you go by the dew point analysis, then first is return in the numerator, and in the denominator, we have capital employed, correct? Capital employed. Now you multiply this on both sides, multiply and multiply by assets and assets. This ratio continues to be the same. Mathematically, it is the same. Sorry. Mathematically, it is the same. Now, these assets can further be multiplied, multiplied by revenue or sales, put down, further multiplied by profits. So what? This is a combination of asset turnover ratio, asset by revenue is a combination. This cancels out this. What remains is asset turnover ratio. This cancels out this. What remains is PAT margin. So the combination. So I'll just show you on Google so that Parth, I did not understand your question. It is possible in other income time? Parth, I do not understand your question. You can explain. Just show you. You can just say dew point analysis. This is dew point analysis, which I wrote it down. Net income by revenue. Revenue cancels out. Average total assets cancelled out. And we have just expanded the dew point analysis in this manner. I hope everybody is able to visibly see the screen. This is called dew point analysis because it was started to be used by a company called DuPont, which is a major multinational company. So, friends, I now open up the forum for any questions because we have only so much time, and I could do justice only to within the given time for 3 hours, only so much. So I will now open up the session for any questions. If you have any, we'll wait for 3 minutes and then we close the session. Over to you guys.
You can raise your hand, and if you have any question, I will allow you to talk. Anybody, Parth? You can raise your hand. If you have any question, I will allow you to talk. Parth. Parth, you can unmute and talk.
Hello.
Yeah, Parth, we can listen to you. Please speak.
Yes,
Hello, sir.
Parth.
I have one question. Yes, I have one question regarding the previous minute. As we
Parth,
have talked
your
about
diction is not clear. Can you talk slowly so that I can probably understand properly? Go on.
yes, sir. My question is about the ROE. As you said, the ROE is ROE is not a greater than always ROE is greater than the ROCE, return on capital employed.
Generally.
But yes, sir. But in case of other income is included in the that ratio, so we can say that the ROE is sometime greater
Okay.
than the ROE.
Okay. See, normally what happens that when you compute a historical ratio, no, normal understanding is that whenever you compute the historical ratio or a forward ratio, you normally normalize the earning. So if the other income is a one-time other income, should not be part of the computation of the ratio. But if the other income is a recurring other income, then it will be part of the computation. Let me give you an example of a recurring other income and a non-recurring other income. A recurring other income is, let's say, for example, you have a manufacturing plant, you are producing cement. To, to safeguard your energy needs, you have set up a power plant. Within your factory premises, what you have done solar roof panels, and whatever electricity is generated from the solar roof panels, you will it to the grid, and the grid gives you money against that solar power grid. You have basically deployed the solar power rooftop units primarily to ensure that your energy needs are safeguarded in the event of any problem. That is generating other income. That other income is recurring in nature. It is other income because your primary business is cement, but you are having other income. That is a recurring other income, and it should form part of the return on capital and the return on net worth computation as part of PAT and as part of PAT plus interest. But if it is a non-recurring other income, for example, you have sold one unit or one plant, and because there was underlying land and the land had significantly appreciated, you have got some capital gains on account of sale of that land, and that gains on sale of land is part of other income. Then in that case, you should normalize the other income before you compute this ratio. Have I answered your question, Parth? Parth, have I answered your question or I need to explain more? Fine.
No, sir, got it, got it. Thank you,
Yeah.
sir.
Any other questions?
Anybody else, if you want to ask the question, you can raise your hand. I will allow you to talk. I think there is no more questions, sir. We can call
Let's
it.
end the session.
Yeah, we should end the
Thank you,
session.
everybody.
Thank you,
Let's
sir. Thank you for the consideration for this lecture. And thank you, dear participants. We'll meet tomorrow at 10 a.m. sharp. So please be there. Yes. Thank you. Thank you, everyone. Thank you, sir.
Shitoshi, you will close the meeting, correct?
Yeah, yeah. We'll close.
Thank you.
Team IT, please do that. Please close the recording and close the